and welcome you with us here on BTTV and Markets Today Steady. 18,048, that's where we're at. Let's bring up those trades for you after that phenomenal bounce back that we saw yesterday. Mr. Chokkalingam is also joining us this afternoon, so let's get straight to it. Mr. Chokkalingam, what are you making of the market mood in the last week of 2022?
Yeah, going was good, and as all of us know, the COVID panic came and market fell last week badly.
Yeah.
I believe that this fear was unwarranted. I see little more recovery, but of course, recovery may not be great because, as all of us know, end of the year, the foreign investors go on holiday mood, and the DAs also follow them. The dull activity happens. But I firmly believe that in January things should improve and recover. Once again, we should hit, breach the record level of Sensex and Nifty we saw earlier in this month.
But Mr. Chokkalingam, just to explain, I mean, if the market was reading into those COVID worries, we're not really in the clear yet. We're still okay. China has said, let's do away with all of those norms. We're just going to have to deal with it. So either that's the kind of stance we're going to take around the world, although here in India, Bangalore's just started a mandatory use of masks, for example, in Karnataka. So it's still a little uncertain how this is going to play out over the next few weeks.
Certainly, I admit the fact that I am only an analyst. I am not a medical professional, but still I can make a strong conviction about this. I have a firm view. First point is that in 90 countries, it is reported that Omicron spread. It started from South Africa more than a year ago. And so far, the experience in the 90 countries is that the existing variants of Omicron, they did not cause huge fatalities. Point number two, yes, if it spreads fast, but it may not cause fatalities. But still, if it, the spread itself causes a lot of worry in China. So what could happen is, they can opt for a severe lockdown, and that would mean China being the largest consumer of oil in the world. The contraction in the economic activities China would lead to substantial fall in the oil prices. That again would be beneficial to India, because according to me, oil is the single most important factor in determining the external economic comfort for India. So therefore, it would be a big positive. And third, so many virologists and scientists, they say that 90% of the Indians are already infected. And we have gone through this Omicron spread, variants of Omicron in the early part of this year and middle of this year. And we survived. And as 90% are infected, so there is no need to worry. So according to me, there is no worry from, the COVID unless any new mutant comes and kills a lot of people. And second, I am not worried too much about the rate cycle also. At least for India, we are at the fag end of rate cycle. Inflation has come down, both the WPI and consumer, and also metal prices are down. Oil price still crashed around 33% from the peak. And also the Rabi crop is too good. Kharif crop was very good. So a lot of good things are happening. So rate cycle also, even for US, I have a view that they are also very close to the end of cycle, and maybe another 50, 75 basis hike could be there. And that should be end of rate cycle. So the real risk can come only from two factors. If there is any war in Taiwan or on our border, or oil price again shoots up to $120 or above, these are the only two things I would say that investors should watch out. Otherwise, till middle of 2023, I am quite bullish on the market. Only after 23 middle, there may be a problem because of forthcoming general elections and uncertainty associated with it. And also the oil price, because a lot of economists predict the global growth would pick up from the middle of 23, and therefore the oil price might shoot up after June, July. So I believe, in a nutshell, there is nothing to worry much about Indian market till June, July 23, except on oil and any possible war in the world.
Okay, let's talk about certain stocks. Broader markets made a huge comeback yesterday, Mr. Chokkalingam, and you're the master of this. So what's catching your eye when it comes to the broader markets?
Broader market, as I said, it could be a marginal gain till end of this year. Next month, it should see recovery. So I would say that retail investors, one has to understand the fact that the investor base has gone up from 4 crore to 12 crore now. All these additions happened in the last 3 years. And according to some statistics, 65% of the investors are now young people in the age group of 20 to 40. So which means there will be a lot of volatility. There will be a lot of momentum actions, both the downside and the upside. So therefore, at the back end of the year, I would suggest retail investors, a proper research, equity allocation strategy, that is, invest at least 30% in the Nifty Sensex stocks, another 30% in the top 250 stocks other than Nifty Sensex stocks, because these are the stocks supported by institution, may not crash the way the small caps are crashing. And remaining 40% you put it in small cap stocks for wealth creation, and look at the six parameters before investing in small caps. One is the management quality, the long listing experience, and least debt on the books, and see that the receivable and inventory are not a substantial proportion of sales and doesn't cause any working capital crisis, and look at whether there is any comfort in the business model in terms of growth, whether it is a sunset industry or rising industry. And then finally, most important, valuation comfort. So let me tell you, India's story would remain as a solid growth story at least for another 5 years, except the possible two risk factors I mentioned, which one has to be alert on the oil front and war front anywhere in the world. If there is any major war, then that can be a problem. So otherwise, believe in India's story, it will be very strong.
Okay, fair enough. Mr. Chokkalingam, give us a few picks though from the broader markets. I mean, as we count down to budget, what's on your radar? Financials, fertilizer, sugar, anything from mid-cap IT? What are you tracking?
Yeah. Don't bank on budget. Just don't invest for budget. Invest for the India story, because the budget momentum will come, and 1 week after budget, everybody forgets the budget in the stock market. So I would say that avoid fertilizer stocks. There are two things. One, the government intends to sell fertilizer under a Bharat brand. So this is a big negative. All the big leaders who spend a lot of money on building brand, they would suffer a lot. And also, a couple of days back, IFCO has mentioned that they are developing nano fertilizer. It's going to compete with the conventional fertilizers. If they are able to succeed, that also will be a major negative. And sugar is always cyclical. I would say that if they keep rallying, take the profit out, because the sugar prices, both the domestic and international market, they are not conducive for the industry at all. And you focus on stocks like HDFC Bank, Reliance Industry, Titan, HDFC Life in the Nifty Sensex stocks. I believe Reliance is emerging as an economy, and I continue to believe that in next 4 years, Reliance can double the stock price because of unlocking. The kind of progress they are making in the retail and telecom is a phenomenal. HDFC Bank, it is going to be evergreen 18% growth story, and Titan also a lot of announcements on growth, and HDFC Life also beaten down a solid growth stock. So outside Nifty, I would suggest stocks like Oracle Financial Software. And small cap for 23, I would present 4 ideas for possible wealth creation. One is Scient. I like this stock. The management has mentioned 60 rupee EPS is possible for FY24. So if they are able to achieve, this will be one of the cheapest mid-sized IT companies, and promoter holding is very low, similar to what I saw for Mindtree. I am not forecasting or misleading people that this will be taken over, but I am pretty confident that IT industry as a whole will go through a lot more consolidation acquisition, because the industry is growing only at 4% annually in dollar term. So that will push for more consolidation. And if it happens in the industry, Scient will be one of the beneficiary. Otherwise also it is one of the cheapest stocks. And second is Swelect, small cap. It comes with risk associated with a very small cap stocks. In fact, I have personally invested, Economics also invested in Swelect and also in Scient. Swelect, I believe that it is a possible multi-bagger. Swelect Energy engaged in mainly in solar, and it has got 100 megawatt of solar power installation, and that itself is valued in the market around 600 crore. Its gross cash is equivalent to the gross debt, and it's almost a debt-free company on net basis. And it, apart from the power installation, it has got end-to-end solution for setting up solar power. It has got costing business to solar modules. I believe it's a phenomenal stock. It aligns with the ESG theme, strong balance sheet, long history of management. So therefore, and also a lot of big players are going for acquisition. So the valuation of companies like Solar Energy focused on solar energy should improve a lot. And the third is Albert David, is a pharmaceutical company. Very surprising that it is quoting at the current level. Surprisingly, the cash held by the company is 60% of the market cap and trading at a single digit PE. These are the three small cap. I believe it's a phenomenal stock to hold. But of course, please keep in mind, small cap always comes with the associated risk. And fourth one is Tata Power. Is a large mid cap. And I believe that this is a phenomenal story in making, coming from good group, and it has now shifted completely the focus on renewable energy. So a lot of things are happening on the renewable front within Tata Power. So this is a great long-term stock. So these are the four stock in small and mid cap I would present.
Okay, amazing. Tata Steel today, let's take a look at that stock, up 4%. While people have largely been shying away from commodity names, but Tata Steel has been consistently performing, and some of the others also in the metal pack. So is this just a buy on dips kind of impact that we're seeing, Mr. Chokkalingam, or do you see anything else there?
I think it is a time to sell steel stock. The steel prices are down in the domestic market as well as global market. And let us not forget the fact that China economic contraction also negative for steel. And Europe, some economies are already getting into recession, and US growth is also contracting. So one should sell, on every rally steel stocks.
Okay, so still a sell coming in there on some of those steel names there. Let's take a look at what else is catching our eye in today's session. Let's just pull up some of the other gainers and losers for you as well. It's still a lot of action in the broader markets. Advanced decline ratio is also looking pretty decent in today's session so far. In terms of possibly some of the capital goods, industrials, infra, real estate, cement names, a huge basket, Mr. Chokkalingam. But as we count down to budget, anything there that looks interesting to you?
Yes, capex. The government would definitely do. Increase the capital expenditures because 24 budget might be a budget of welfare, because normally the welfare schemes are announced close to the election, not in the distant past, because voters will forget. So therefore, this government might focus heavily on capital expenditure to usher in growth further in 23 budget. So the budget is going to be year of capex plan, and therefore capital expenditure capital goods companies like maybe Siemens one can look at, and also the banking, nothing to do with the budget, but a phenomenal structural change which the market has noticed and rewarded, and still I believe it's a long way to go, because the credit growth, after crashing to as low as 5% during COVID pandemic, it has now picked up to 15 to 17%. It's a record level of growth in the last 10 years. And it is coming at a time when the NPA cycle has come down a lot. And, therefore, one should stay invested and should have a lot of tilt towards banking sector. And that is where one can look at HDFC Bank and even high beta names like, Kotak Bank or Axis Bank. So that would be my strategy. So these are the two sectors I would say that, in the light of budget, partly one can look at.
Okay, let's go across to Tanya for some buzzing stocks as well.
Absolutely, Aabha. So firstly, sugar stocks are on a roll today. So shares like Sri Renuka, Balrampur Chini, Triveni Engineering, Dwarikesh Sugar, Uttam Sugar, they are all up in the trade today. So basically, Ministry of Consumer Affairs, Food and Public Distribution announced a 100% incentive on sugar sacrificed for producing ethanol from B-heavy molasses, sugarcane juice and syrup, and this is likely to boost stock holding limits for sugar mills. We also have Mahindra CIE. Now the stock gained over 3% in today's trading session over the board's decision to sell off its German CV forging operational segment. And brokerage house Motilal Oswal also believes that this is a step in the right direction, and it has a buy rating on this particular stock with a target price of 360 rupees. We also have Central Bank of India. Now, this bank will acquire remaining 35.6% stake in Cent Bank Home Finance from existing shareholders. And also, its board of directors approved to raise up to 1,500 crore rupees this fiscal by issuing Basel III compliant bonds. Shares of Kinetic Engineering also hit 5% upper circuit limit today. Now, this is after the company said that it will commence production of assemblies for Illuna. So, Illuna will be launched shortly by sister company Kinetic Green Energy and Power Solutions. We also have Philatex India. Now, the shares zoomed over 12% today after the stock turned ex-split. Now it turned ex-split in the ratio of 1:2. And the stock's face value shall change from 2 rupees currently to the new face value of 1 rupee per share. Shares of HEG Limited also are in focus today. The share zoomed over 9% to hit a day's high of 1,055 rupees on the Bombay Stock Exchange. Now this is after the company incorporated a wholly owned subsidiary company, TACC Limited, and TACC Limited would manufacture graphite anode for lithium ion cells. Lastly, we have Time Technoplast stock as well. Now shares were up in the trade today, extending their gains for the second straight session after receiving repeat orders from Adani Total Gas, and the stock jumped over 19% today to hit a day high of 99.6 rupees on the Bombay Stock Exchange. Back to you.
All right, thanks for that, Tanya. Okay, so lots of stocks that are catching our eye today, and it's looking pretty good all around. So, Mr. Chokkalingam, are you tracking any kind of range then as we head into the new year? Budget seems to be, the next milestone, even though we're going to start to see earnings kick in as well before that.
Yeah, in fact, we believe that from current level, the Sensex and Nifty can give 10% return by June, July. But as I said, I am quite skeptical about the market after June, July. As I mentioned, market will start, thinking about the forthcoming general election after June, July of 23. And second, my biggest worry is oil front. We have been having a perennially trade deficit, and the renewable energy story is going to take another 3 to 5 years before it starts helping us to substitute oil to meaningful extent. And most global institutions expect economic growth to improve worldwide after June, July. So therefore, also consider the fact that OPEC and Russia have been successful even when the economies were going through tough time. In the last 6 months, they were able to jack up the oil price to as high as $128 per barrel. So when economic growth improves in the middle of next year, and if they are able to succeed in taking the oil price to 120, 140 range, that will be another big risk factor. So I would say that, till that time remain bullish, but however as I mentioned, keep your equity allocation in a proper way to manage any possible risk in the second half of 23. That is by having 50 to 60% exposure to, top 250 stocks. It doesn't, I'm not saying that they would not crash along with the market, but then they fall less than the small cap, and also they give you easy exit. So that should be the strategy for next 6 months, hoping for 10% return. But there are many individual stocks which can beat this and can give possibly 15-20% return. So therefore, focus on quality stocks, stay invested till June, July with a lot of optimism.
All right, great. Mr. Chokkalingam, thanks so much for joining us today. Markets are steady. They're looking good, in fact. Tata Steel is one of the top movers. Hindalco, JSW Steel, even though everyone's saying sell on rally when it comes to metals. So the mix has changed today. Financials, of course, continue to be on everyone's radar. Lots of broader market picks that Mr. Chokkalingam also highlighted as broader markets continue to outperform the indices yesterday also, today also. A lot of action picking up there. But markets are not completely out of the woods yet. I'd still say be a little cautious over the next few weeks as things really firm up, and once we get clarity on how things will really play out in the new year. That's all from us for now. Thanks for watching.